everyone to NRM Regions Australia's In the Tent webinar series. I'd like to extend a special welcome to Nicole Yazbek-Martin from the Australian Sustainable Finance Institute, who's presenting to us today. I'm Matt Hardy. For people who don't know me, I've recently joined NRM Regions Australia, leading a project on participation in environmental markets. I'd like to start by acknowledging the traditional owners and custodians of country throughout Australia, where we live and work. I'm zooming in from the lands of the Wurundjeri today, who are the traditional custodians of Melbourne and its surrounding lands. I'd like to pay my respects to their elders past and present, and to extend those respects to elders from wherever you are zooming in from today. NRM Regions Australia acknowledges the role of First Nations science and stewardship of healthy country, and their deep and enduring connection to lands, waters, and communities. We pay our respects to First Nations cultures and commit to working together to care for country. This webinar is part of NRM Regions Australia's In the Tent with NRM series, which features speakers requested by our regional NRM member organisations, or sometimes in response to an offer from one of our partners to share their work with the regional NRM community. Today, we welcome Nicole Yazbek-Martin from the Australian Sustainable Finance Institute, who has offered to speak to us from within the tent on ASFI's draft Taxonomy financial classification system. Nicole is the head of Taxonomy and Natural Capital at ASFI. She is currently leading the development of the Australian Sustainable Finance Taxonomy, working closely with government and regulators to develop common definitions for sustainable economic activities and investments. Nicole also leads a body of work at ASFI with major finance sector entities to integrate nature considerations into financial capital allocation decisions. Nicole speaks to us today with a background in climate and sustainability through government, banking, private equity, and the law. She has deep knowledge and experience working across the finance value chain on structuring sustainable products, assessing sustainable investment credentials, and applying key sustainability monitoring frameworks. She's also led the review of major climate policies, including of the Emissions Reduction Fund, during her time in the public sector. Nicole's presenting to us today about ASFI's draft Sustainable Finance Taxonomy, which is a financial classification system that will be used to define sustainable economic activities in a credible and transparent manner, helping to accelerate the allocation of private capital towards activities that support Australia's sustainability goals. Today's session, Nicole will be providing an overview of the taxonomy's development to date and the work being put forward for public consultation at present. I've also scheduled in some time with Nicole at the end for some Q&A. Thanks very much, Nicole, for offering to come along into the tent today and share your work. Just letting everybody know that we're recording the session and we plan to make it available publicly. It's about a 30 to 40 minute presentation from Nicole and then some questions at the end. We encourage you to pop your questions into the chat as we go, and we can ask them of Nicole at the end during the Q&A. If you wish to, you're also welcome to keep them in your head, keep them close to your chest until we get to question time. We've also got a Menti survey that we'll be posting through soon, so we can get some feedback on the session today. All right, over to you, Nicole, if you want to bring up your slides and we'll kick off.
Thank you very much, Matt, and thank you for providing the platform to be able to speak to your membership in the NRM regions. I've probably met and engaged with a few of you before, which is always a really great and fantastic learning and sharing experience. And so really happy to come and chat to you all again today about the Australian Sustainable Finance Taxonomy, and particularly focused on agriculture and land sector criteria, because I think, of course, that's of most relevance to this group. Happy to touch on other aspects, but there's videos online and documentation. So if you're interested in things like decarbonisation in the manufacturing and steel sector, you're welcome to dive into those. But I think I'm very excited to actually speak about what I love the most in terms of this area, which is ag and land and the natural environment. So, a bit about us as an institute, ASFI, or the Australian Sustainable Finance Institute. We were formed, I think, now 3 and a bit years ago, off the back of what was a collaboration amongst the financial services sector to really think about what the role is of the finance sector in driving a more inclusive, sustainable, and resilient Australia, and what role capital can play in that. And really thinking about how, and I think a recognition that we needed to realign the system in order to ensure that more capital flows to those sustainable outcomes, and particular with a particular focus on helping us to get to our net zero goals. And so as part of this collaboration process that happened with industry, they identified a suite of different recommendations about what the financial services sector could do to play its part in ensuring more capital flows to the areas that we needed to. And one of those recommendations was a taxonomy, a sustainable finance taxonomy. It was seen as pretty crucial to help enable the identification of the types of activities that happen on the ground that we should be encouraging more capital to flow towards in order to ensure that we have more sustainable outcomes on the ground. So ASFI as an institute was formed to permanently drive those recommendations, including the development of a sustainable finance taxonomy for Australia. And we are now 43 of Australia's largest financial institutions across the full financial services spectrum. So Australia's banking sector, asset owners or our superannuation system, so your pension funds, my pension funds, asset managers, as well as insurers, and I guess you could say everybody in between in the financial services sector that sort of prime and align the system. And we're not a peak representative body, so we don't advocate on behalf of our members for industry interests. We have a purpose or mission driven organization with a clear set of objectives, and membership of ASFI is really signing up to endorse and support that mission to drive those outcomes to 2030. So the development of the sustainable finance taxonomy was started as an industry led initiative. Really, like Matt said, I think articulated very well. So, congratulations, Matt, because a lot of people are like, a taxonomy, what? But a taxonomy really is a classification system. And what it does is identifies economic activities across the economy. So, different sectors of the economy. It identifies the activities that sit within those sectors and whether or not those activities make a substantial contribution or aligned with our sustainability objectives. There are 6 sustainability objectives defined in the taxonomy. They cover off on climate mitigation, so that's aligning our economy with a net zero outcome aligned to the Paris Agreement temperature goals, as well as adaptation and resilience, environmental objectives that are aligned to the Kuning Montreal biodiversity framework around biodiversity and water, the reduction of pollution, prevention and control, and helping us to transition to a circular economy. In this first round of taxonomy development, we have identified economic activities that drive or make a substantial contribution to climate mitigation outcomes. And that is aligned with the government's priorities of sort of the sustainability agenda, which is a climate first, but it's not a climate only agenda. We, as ASFI, would prefer to do everything and ensure that we can identify multiple activities that drive one or more of the environmental objectives. But currently, we have a mandate to develop climate mitigation objectives. And next year, we'll be starting to pilot identifying economic activities that actually drive positive environmental outcomes, so biodiversity outcomes and water outcomes, but that's not in this section of that's currently out for public consultation. And what this classification system does, so it's not necessarily going to be used by everyday people pick it up and use it. It's really a classification system for the financial services sector, so the banking sector who lend capital, and for investors who make investments in portfolios of assets, to be able to identify those activities that are actually going to drive sustainable outcomes so that they can put more capital towards that. So you can kind of think about the taxonomy as a shopping list for the future for the financial services sector, who are really seeking to increase their exposure to sustainability related activities. It's really important to help bring, I guess you could say, some maturity and robustness into the sustainability market, because as we know, the market itself is rife with claims around everything. There has been a lot of greenwashing. When these new markets emerge, there's this burgeoning, everybody wants to be green, everybody wants to be sustainable. You walk down the supermarket aisle and you're like, really? And so there has, as a consequence of that, I think the ACCC and ASIC have really been kind of trying to stamp out that. But what we do want to do is ensure that that doesn't lead to like a green hushing. We do want to continue to grow the market, the sustainable market. And so we really want, this is almost like a tool to help identify those key activities that are sustainable. What we're not doing is describing things that are not sustainable or what is not sustainable. So, and we're also not covering the whole economy or even the whole sector. So just because an activity is not listed doesn't mean that it's bad or it's brown. But what we are doing is starting to create a list of things where we have confidence that they do drive sustainability outcomes, and that is really based on what is at least in this sector, a lot of science that has been put behind, practices that have been happened on the ground, information and inputs over the years that we can all agree these are the things that we know are going to be driving good outcomes on the ground. And that's the first list, or the first cut that we've included in this taxonomy. What importantly it does do at I guess you could say at a macro level, is it does help to increase access to favorable green capital, favorable global green capital into the Australian market. There has been, Australia is a very high emitting sector, and if you're looking at economy, and if you look at it as a whole, might not seem as attractive to green investors, taken holistically, given sort of our export profile, as well as the fact that, if you just have to take a simple emissions metric, even within our agricultural sector, although we do agriculture very efficiently, we export things like beef, livestock, etc., which taken on a simple metric without that detail around what is and isn't sustainable within that market, can be seen by global capital markets as not an attractive proposition. And so what we've really wanted to do is help to provide that granularity within the sector itself to show what are sustainable practices within that, to increase that flow of capital into our different sectors, and in this instance into our agricultural sector, which we believe is very much holds itself up as sustainable relative to other world production areas, production regions, but also we want to increase that share of sustainable finance that goes into sustainable agriculture in the future. This does mean we follow quite a robust and credible framework. So, like I said, with regards to the agricultural sector, we've really sought to identify those areas that people can relatively agree that these are the areas that we can get started on. It's not an exhaustive list, and hopefully will grow over time. But we did need to start where the scientific rigor is there, where there's a high confidence and a high likelihood that the practices and activities that we've identified and incentivizing do actually drive sustainable outcomes on the ground. And hopefully, as data is collected and as more practices come to the fore, we can increase that list over time. Importantly, what it does not do, it is not in any way a capital direction tool. It's not regulated into the system in a way that tells you what you can and cannot invest in. It really does sit as part of that new or in climate disclosures language, we like to call it, forward capital allocation decisions. So when you are thinking about, and in most instances when companies or asset owners like our pension funds are thinking about where they want to allocate capital towards climate solutions, they look at this list and they say, okay, I can increase my exposure to these types of activities. And in some of the superannuation funds that have started to get into, and it actually has been interesting to see how superannuation funds have shied away from the sector for so long. But for those who are actually looking to increase their exposure to natural capital assets, this has actually been really helpful for them to be able to start to think about those assets in a way that really does tell that story. So, sorry, that's going backwards. Just quickly in terms of how the Australian taxonomy has been developed to date. So, like I said, it did start out as an industry-led process, and it was really financial services sector within Australia really wanting to create a taxonomy that was fit for purpose for the Australian context. The European taxonomy is there, it's out. It is a benchmark taxonomy that's used by many markets, but it doesn't cover off on many parts of the economy that are very important to Australia. Obviously, mining is one area, but another key area is the agricultural sector, right? So they have forestry, but they don't have agriculture. And I don't have to tell any of you that work in agriculture and land management that we do things slightly differently in Australia. We have very large landscapes, we manage them differently, and that just was not showing through in the current frameworks. And so the Australian finance sector really wanted to get ahead and start to develop something that was fit for purpose for Australia so that we could attract that capital. Obviously, when the current government came into power in 2022, it saw, it made some pretty strong commitments around net zero. It made commitments around developing those sector plans, and it also saw the value in private finance doing its bit to invest in the sustainable future. And so that's where we sort of joined partnership, or we came into a partnership with government. It is still a sort of an industry-led process, so it has an independent technical expert group that are shaping up the development of this taxonomy, but we now have the support of government and our Council of Financial Regulators, so that's the Reserve Bank of Australia, ASIC and APRA, and Treasury, have a strategic oversight role of the project itself. ASFI ourselves, on behalf of industry, we are the secretariat. So we're not decision makers. The technical expert group are the decision makers. We work with experts in the field who provide input into the technical aspects of the taxonomy. And then we have an advisory group for each sector. So our Ag and Land Advisory Group is 20 people strong, I think. So it is quite a significant group. I probably put a call out. We are probably looking for one or two more that have expertise in other environmental objectives or environmental markets. I might touch base with Matt offline to see if people are interested in that. But our current group that are focused primarily on climate mitigation is made up of a suite of different people within the ag and land sector, from forestry, from banking and finance, from agriculture itself, as well as technical experts and scientists in the field that have helped work with us on this initial list of criteria for the sector. And then, of course, why I'm talking to you today is that we're currently out for public consultation, so very keen to get people's feedback on this draft criteria that's currently out to help shape up the final criteria, which will come out in December. So, like I said, taxonomies follow a sort of a framework approach where we identify environmental objectives that we all care about that are benchmarked against our biodiversity, water, and climate objectives, generally global frameworks that Australia has signed up to. And from a pollution prevention and control perspective, things like the Montreal Protocol and similar. We identify sectors in the economy that we think can drive, or that there are activities within those sectors that can really drive mitigation outcomes, and where we need to provide capital and private finance to help decarbonize. And so ag and land is one of those sectors. And then you identify economic activities within those sectors that, if they operate in that way, that they will then be classified as green, and or key measures or things that you can undertake to that activity to help to drive it towards climate alignment. If you're doing good in one area, we don't want you to cause significant harm in another area. And so that's where this concept of do no significant harm comes in. So if you are undertaking a measure or you are undertaking an activity that's seen as driving climate mitigation, then you need to also demonstrate that you're doing no significant harm to the other environmental objectives. Um, that do no significant harm is a baseline regulation. So we're not making claims that you are driving mitigation outcomes and biodiversity outcomes, but you can't be doing significant harm to that biodiversity outcome. So that's generally pegged at a legal compliance baseline, mostly in Australia. We have compared our sort of environmental compliance baseline with other OECD countries, including Europe, and it is pretty comparable. That's not to say that we think that Australia's laws are fit for purpose and shouldn't be improved over time, but that's probably out of scope for the taxonomy. So we do hope, as Australia's environmental regime is beefed up and improved towards nature positive, then that baseline will just lift up with that. And then there are some minimum social safeguards, and in the case of agriculture, where we're talking about livestock production, that also means sort of animal welfare as well. And so what we do within the taxonomy is we sort of look at two things. We say, okay, can we identify a whole activity as being either making a substantive contribution to climate change mitigation based on the science, so that's 1.5 aligned scenarios, or it's already aligned there, and if not, and we know that the activity still has a continuing or increased role in a net zero economy, so we're not identifying things that we know need to phase down, we're identifying activities that will continue to be needed in a net zero economy, but we can't currently undertake that activity in a way that is green because we don't have the technology or we're not able to figure out how to get it to net zero. Can we identify measures that can help decarbonize that activity? So in the case of, and we apply this methodology to every sector. So in some sectors like the energy sector, when you ask the question, does this activity have a continued role in a net zero economy? Some activities, the answer will be no, because that whole activity, and the easy example is coal mining, will need to be phased down. And there are low carbon alternatives that can generate energy, so we don't need that anymore. When it comes to agriculture, I think the answer is a resounding yes. We definitely still need food and fiber within in an economy. Also, when it comes to landscape management, we need a lot more of it. We need to be looking after our environment. We have new and emerging asset classes in biodiversity and other things. And so we actually, all of this, we need to encourage capital into. And for those productive elements, so the agricultural elements, we need to find ways and pathways to help decarbonize, even if we can't classify it as green immediately because there's limited emissions reductions. So that's the approach that we've taken. And I won't go into detail on this decision tree, but this just sets out in a little bit more detail the way in which you follow whether something will be classified immediately as green. And if it can't be classified as green because there aren't actual ways to do that right now, then we have what we call our transition category, our decarbonization measures. It doesn't make it a lesser or a better category. So that's not, I guess, the way to think about it. What we're really seeking to do is channel capital to get a environmental climate aligned outcome at the end of the day. So for many activities, and this is most of the activities in the agricultural sector, we can't call the whole activity green. And I'll talk about, the reasons we don't have baseline data. There's limited technological options. So what we've tried to do is identify as many measures as possible that can help improve and drive decarbonization or act as a proxy for decarbonization. And hopefully when we get started on the other pieces of work, or can act as a proxy for adaptation and resilience, or improve resilience on farm, or drive biodiversity outcomes on farm. So for the sector, when we talk about the sector, what we're really talking about what happens in the boundary lines of a landscape, really. So this kind of demonstrates more a farm, but equally we also do it for forestry and we also do it for landscape management. So if you're in restoration activities, so we're not looking at upstream, so how you produce the fertilizer, that's done in the manufacturing and industry criteria, but it's how you use your inputs, the energy that you use as part of the actions that you do on your landscape, and then the outputs that are produced and the way you produce those outputs. When it gets to the farm gate or outside of that boundary line, then it will go into another sector. So we're really talking about that piece in the middle there in the amber and the blue categories. That's the boundary lines of what we're talking about in this sector particularly. And ordinarily, when we develop criteria, we take quite a robust scientific approach. So we have scenarios aligned with the Paris Agreement, so 1.5 aligned scenarios. We take the starting point, which is usually the top 20th percentile or the top 15th percentile. So the high performers is the starting point, and then we create an expectations around the emissions intensity of the activity that you're doing aligned to that scenario. Of course, that doesn't work in the agricultural context and in the landscape management context. And I think probably needs no explaining to those on the call the reasons for that. So I'll kind of listed a few here. There are, of course, methodological differences and approaches to data sources, particularly with regards to estimating emissions reductions at a land sector. Um, you can get that information nationally, but once you get down, and particularly when you get down to sort of a farm gate level, it's very complex and difficult to do so. There are a lot of interconnected biophysical factors that mean that there's no one size fits all necessarily. And given the fact that it is a dispersed a sector, it is the SME sector, I guess if you have to call it, the poster child of the small medium enterprise. We have over 88,000 farmers operating in Australia's landscapes. It's not that you have these easy big emissions data buckets with one or two big players that you can really identify. This is your starting point and this is where you need to get to. This also makes monitoring and verification very challenging. And I think last but not least is just a recognition that there are limited options right now for the sector. We obviously know that the sector is a massive sink, and we want to recognize that and encourage that. But if you're doing a productive activity on a farm, you're doing that productive activity. There is not necessarily a wholesale way to do that in a way that is net zero. And so all of these things make it very challenging for us to take that traditional approach with an emissions intensity. And definitely, I think what we try and avoid at all when we're talking about activity level criteria is an absolute intensity reduction, because that just leads to perverse outcomes and it's very difficult to share and compare. So um, we've done a lot of research on this. We were hoping that the Climate Change Authority would come up with all the solutions. Of course, of course they did. This is actually a snapshot of what they looked at in terms of what are the decarbonisation levers for the sector. And I think no surprises to anyone, so immediately we know that there are things that we can do and they really fit within the bucket of good land management practices or good herd management practices. So these are really all the measures and management practices that we know that we can do now. There's some kind of improvements with regards to genetics and feed supplements that are starting to emerge. And of course, there's a lot of progress that's been made with regards to optionality, and hopefully that will increase over time with regards to fuel use on farms. So energy efficiency equipment and better equipment and renewable energy, etc. And then, of course, we know, and hopefully, and this is really an economic issue, not not a technological issue, is how can we increase the return on investment profile to encourage um, broader and diversified landscape management, which includes and incentivizes, looking after your natural landscape on farm for the purposes of becoming a sink, and hopefully moving that into biodiversity as well. So how do we increase that optionality, so that is actually a viable option for landholders to participate in those markets. So all of that being said, that did form the basis of the economic activities that we have in this initial round, and have really been seeking to work very closely with our advisory group to ensure that while we are creating I guess you could say, a bit of a shell or framework around each of these activities, that we're giving enough space for it to be applied at a per farm or per landscape that is unique to each and every landscape. So um, we encourage the baselining and then the tracing of that, but we're not making stipulations about what that baseline may be. When we look at things like nutrient management, we are talking about nutrient efficiency use. We are not dictating what that reduction should be, because we know and recognize that that will be very dependent on rainfall and crop type and all that type of thing. So really trying to create the space for that activity to take place, but leaving the decision making around the best way to do that and how to do that to the uh, land manager themselves. And so what we've identified is sort of a suite of measures, or practices across the cropping systems, with some particular bespoke activities or things you could do for rice production. And I know that's quite a small activity within Australia, but cropping systems, animal production systems, and then across the board, whether it be for agriculture, forestry, or other land management activities, so management of natural ecosystems, allowing support activities to be funded as green. So anything to do with research and development, monitoring and verification, training around emissions management, as well as all your plant and equipment and investments and that type of thing. So that will all, I guess, be eligible, and then particular land management practices that would also be eligible. And really the buckets of things together. So obviously the detail is in the paper, and we encourage people to go have a look at those. It really steps out that you should put in place a plan, do a baseline. There's a whole suite of things that if you undertake the following things with crop nutrient management, that would be all of the cost of that would be eligible. The same with the multitude of practices that you can do to increase your soil carbon, and really what we know and what we've included here is things that we know um, are good. The science tells us that increasing your soil carbon, increasing your crop nutrient management, your shelter belts, improving the vegetation on your farm, all those things can act as proxies for decarbonisation, and so we want to reward them, notwithstanding the actual reductions that it gives. What we do want to do is start to get people to measure and compare, but we're not being stipulative about what that looks like. So this is, I guess, the first stab at what's there. What we have asked in consultation paper is there anything glaring that people are like, that's an obvious thing that you should have included, that you're missing. And of course, this is for our agricultural sector. We also then have for our forestry, and that's for both managed forests as well as conservation forests. We have afforestation, reforestation, forest management, as well as landscape management. Restoration of wetlands, restoration of ecosystems, and savanna landscape management within the context of grazing and as a standalone managing savanna landscapes. So and then of course financing for participation in our ACCU markets is, so any financing costs associated with that would also automatically be eligible, and like I said, support measures including research and development. And I think I might leave it there. This is probably getting a little bit technical, but usually put this out there to kind of show like to people like what does this mean for me. And I think I touched a bit about this on the beginning, but this is really, I guess, the way we look at the way taxonomy can be used. There's really kind of two levels. On the bottom light blue kind of line is what we call activity as an activity level tool, which is probably the kind of biggest level of engagement with regards to financial institutions. So structuring of green loans, and hopefully, what we see is potentially products emerging that are more sophisticated and more fit for purpose for the agricultural sector. I know the green loans to date have been quite limited and not necessarily always helpful or useful, but we can see products starting to emerge where a farmer might have a management plan in place and pick 2 or 3 of the measures that are under the taxonomy, and then be able to call their whole farming activity as green and get a general purpose green loan, as opposed to a bespoke loan that would have to go to the financing of a particular capital investment measure. So that's the type of way in which we hope the taxonomy will grow the market and provide more optionality for kind of landholders and farmers. We want to increase the flow of finance to participation in things like carbon markets, and hopefully when we do the environmental criteria, increase the flow of capital to nature markets as well. And then there is also, I guess, if you're looking at it from an entity, so that would be the farming entity themselves. I don't think it would apply to the majority of kind of farming enterprises, but for those that would meet the hurdle for having to report against climate disclosures, it's actually a very helpful metric to be able to say, look what I'm doing. So it's an opportunity. It can be identified as an opportunity metric if you're making investments or you're doing land management practices and you are falling within that threshold of reporting, but also in things like developing transition plans, like I'm currently doing this and I'm going to be putting my efforts towards these things. That's another way that taxonomies are very useful as well. Like I said, that probably won't apply to those that fall outside of that threshold, but there are, I think, farming enterprises or regions that might be interested in that as well. So I think that's it from me. Happy to take any questions that people have.
Wonderful. Thank you, Nicole. That was super interesting. Really, really interesting presentation. Thank you. And thanks for sticking around for some Q&A too. Reminder to everybody to pop your questions into the chat, or I also invite you to raise your virtual hand and turn your camera on and ask Nicole directly. Does anybody have any burning questions they'd like to front up first? Chris, thank you.
G'day, Nicole. Thanks for that. Our CMA is really focused on carbon programs that benefit the environment more so. So we've made I suppose, a stand to stay away from soil carbon because we feel it's not a public benefit. We know that if we address we don't undertake actions on a paddock, the paddock's still going to be there in 20 years. So we're focused on our carbon sequestration priorities on blue and teal and green carbon. So knowing mainly because a lot of those natural assets are going to be quite modified over the next 20, 30 years with climate change, like estuaries, wetlands, waterways, and the like. So I just, it'd be good to see those sort of names come up a bit in what you guys are doing, because I think there's a huge opportunity there, especially for business. 1 hectare of blue carbon habitat equates to about 55 hectares of tropical rainforest. Yeah. The numbers are matching up, and the tropical rainforest has a lifespan of 0 to 100 years. Where the tree dies and that carbon's released, these blue carbon habitats can trap the carbon for 3,000 years. And usually in areas that farmers aren't competing directly for productivity. So it'd be good to have those sort of things in the mix as well. Thanks.
Yeah, no, thanks, Chris. Those are really excellent points. And sorry, my slide deck doesn't reflect the fact that those restoration of what we haven't done, I'll be interested in maybe this is a feedback point for us in terms of we didn't have the opportunity to move into blue landscape, so we haven't defined sustainable fisheries, which would include productive elements of that, but also restoration. We've identified all the carbon market opportunities with regards to blue carbon, so that is included. We've included restoration of wetlands, but we haven't gone further, I guess, into into the blue, so to speak. So to the extent that they are covered under those sequestration activities within the ACCU market, they are included in funding for the taxonomy, and hopefully you guys would be able to get that funding through that. But if we haven't been able to sort of define what green is in the blue economy outside of those participating in those markets. Also, hopefully, when we look at the other environmental objectives, we want to get as broad as possible into restorate all sorts of other restoration. But yes, we have included restoration of wetlands and participation in the ACCU market with regards to those blue carbon methods.
Great. Thanks, Chris. Thanks, Nicole. Who's next? Who's going to be brave and ask a question? I've got some that I'll put forward whilst people have got their thinking caps on. Nicole, I'm going to put you on the spot a little bit here, but do you have a sense of the experience elsewhere of the impact of sustainable finance taxonomies, how much they've altered or changed investment into sustainable activities?
Yeah, it's a really good question, and I think data is only now starting to emerge. What we have seen is the growth of the green bond market, which is kind of the beginning stages. And that really only started in 2012. And I think the first green bond issuance was from the World Bank, and it was like $1 billion or something. And now it is a multi-trillion-dollar industry. That's fantastic. Of course, it's not, I would say the majority of that has gone into renewable energy, and you're starting to see pockets of that sort of flow into other hard to abate sectors. The proportion of that that's gone into the land sector is negligible at best. Part of the reason for that is it's just has not been identified as an asset class. So, back to my point around why Australia wanted to do this, we want to elevate this as an asset class. The natural capital environment has been starved of funds in general, and sustainable funds for a very, very long time. The EU taxonomy didn't end up including that, and so it it's been much more constrained. While you have seen huge flows of green capital coming in, and those are increasing, it has been constrained relative to the land sector. What you have though started to see emerge is sort of the likes of bespoke natural capital funds like New Forests, which have really started to get the game going, and it was fantastic. I was actually sitting in a roundtable with them yesterday to talk about they're now $8 billion, which is still small in financial market sector speak, but it's starting to get to the size where, and most of their investors are actually institutional capital, so our pension funds and stuff. So, and what I've seen in the last 3 years is an increase in exposure to those types of assets, or an inclusion of those real assets for the first time in their portfolios, which is encouraging to see. So we're hopeful that as the sustainable sort of optionality is opened up, plus the drivers like the market mechanisms like the TNFD and the recognition of climate and nature, and I think a very significant thing that has just happened that might have not missed a lot of people's radars is the latest guidance from the international capital markets through SBTI and GFANS around including nature-based solutions as part of even your climate transition. So we're not asking people to do a whole new transition plan, but to start to incorporate nature as part of that. All of this, we hope, is going to really start to increase that flow of capital. So while we've seen it while we've seen it happen in other sectors, we're starting to see it anecdotally in the natural capital space, and we hope that that will increase exponentially.
Went on mute there. Thank you. That's really great. Anybody else? Oh, we've got a question from Linda. Would you mind coming off mute and asking it directly, Linda?
Oh, thank you. Thanks for the presentation. That was great, Nicole. Actually, I just really wanted to know, in terms of the nature repair market, how developed or advanced does that need to be to influence, I guess, the flow of green investment? Or really, can we just sort of move independently of that? Because I guess there are some concerns around, how long the nature repair market might not take to establish. And so can they be decoupled, or are they decoupled?
Yeah, so I definitely don't think the nature repair market is necessary for capital to start to flow into the space. I mean, I think with the nature repair market, they are creating the mechanism, but they haven't created the market yet, right? So the mechanism doesn't create the market. It's helpful and it's useful, but I think the supply and demand dynamics and the I guess price signaling and the role that government or blended finance will need to play in the beginning stages is going to really need to be in place to get that market going. But I think what you are seeing is that other parts can start to move ahead, right? And that can take the form of different types of things. So to the example of New Forest, which I'm sure many of you know well, they still do their core business, which is why I guess we focus a lot around agriculture is almost like that return on investment. It's the absolute necessary that needs to happen. But then they look at all the additionality that they can start to stack. And some of those are just good for sustainability and good for resilience. So we'll do them anyway. But in the future, when the market becomes a market, that it's like an added on that will start to diversify revenue and increase revenue. And that's quite attractive to an institutional investor who says, minimum worst case scenario, I'm going to get this return on investment that I know I can get now, and it meets my shareholder needs and expectations. I'm a long-term patient investor, so I'm happy with this kind of returns, but there's this optionality in the future that I could start to get revenue from these other sources. And so I'm going to, this makes it quite an attractive investment. So I think that's why we're focused in the taxonomy in making sure that we can make the core productive landscapes attractive, because they've traditionally not been understood and so not necessarily attractive, with the hoping that the market that will be used as sort of the entry point, and then the market will develop on top of that over time.
Great. Thanks, Linda, for your question, and thanks, Nicole. Anybody else have a question? I'm just going to follow on from that while people think. And noting that it's quite clear that the current focus is on the climate change mitigation objective, Nicole. I guess, your preliminary thoughts on how and when the taxonomy might try to tackle the other objectives like biodiversity and ecosystem protection or sustainable use of water, etc. Yeah.
Yeah. So, look, we were hoping to get it all. We were hoping to be able to at least develop adaptation and resilience criteria, which I think very much goes a long way to being able to, because I think we know instinctively, but also scientifically, that looking after natural capital almost always increases your adaptation and resilience. Unfortunately, we didn't get the funding for that based on just I won't get into. I'm sure you guys know well how government works. This is being recorded. I shouldn't say that. No, but due to the complexities of sort of prioritization, but we have been able to secure a pilot with DQ that will start in January next year. It'll run until the end of April. We've already started doing kind of preliminary looking work on that to identify activities that drive both biodiversity benefits and or water benefits and or reduce pollution prevention and control. So things like practices that will reduce runoff into the reef or other sensitive areas, management of ecosystems through feral management, etc. Restoration of additional ecosystems that don't necessarily have that clear carbon benefit but have biodiversity benefit, and so hopefully that will be kind of put in as a recommendation set to be included into the official taxonomy, and we hope that that will be included very, very soon after that.
Yeah, fingers crossed. Really important. Thank you. Sorry, you've got your hand up.
Yes, hi, really interesting. Look, with the risk of boring other people, could you just give me maybe 5 dot points, the core of this new forest fund? You said it's about $1 billion, including pension funds and others who kind of are seen as fairly conservative investors, right? Do you mind giving just a really quick overview? Who are they domestic investors? Are they already international investors? Just a really quick sort of picture of the interest of those more traditional investors into something sort of kind of pretty esoteric. Way.
Yes, so the fund itself, and not talking on behalf of them in any way, so please excuse me if I get things wrong, but the fund itself is made up of traditional forestry and agricultural assets, and then like they overlay that with conservation efforts as well as participation in ecosystem markets. So the participation in those ecosystem markets is dependent on the market itself, so it's quite localized. They have assets in Australia, assets in New Zealand, in parts of, I think, Latin America, Africa, and in America as well, so North America, Oregon, and California. And so the California has got its own market, which definitely provides great revenue streams. So even their carbon cap and trade scheme, 50% of your carbon credits need to have what they call I think it's a DEF, or I can't remember what the name is, but it has to have other environmental benefits. So 50% of all credits you buy, half of them have to show additional benefits. Which I think is actually a very smart mechanism. So something to think about, Matt, when we think about models for helping get the nature repair market on the go. So in that instance, that asset class, in addition to the traditional forestry assets and the stable income that provides, they have a huge conservation piece attached to that, and they derive, like I said, that additionality. That makes it very attractive, and you have Californian pension funds that are invested in that. You have Canadian pension funds. You have kind of government, sovereign government funds, and that are invested in that. In the Australian market, I think they participate in the ACCU market. They own the Foraco assets, so all of the assets that sit in Tasmania, of which over 100,000 hectares of that is conservation forestry. In other parts, like in I think they own assets in Kenya. There's a local trading scheme there. So they do center, like I said, they kind of anchor their activities around the productive landscapes, make sure that they implement those best practice land natural capital management practices, which do increase their returns, provide that economic stability, and then they start to work at growing those additional markets, which creates that additional revenue, which is very attractive to institutional investors. I believe there is at least 1 or 2 Australian superannuation funds that are invested in that fund.
Excellent. Thanks very much.
Great. And Chris, you might have to have the last question. Sorry.
This might be a good segue to finish off. Something you said before, Nicole, that you didn't want to say about government. I think as NRMs we have the same issue about government, and I think there's some lessons learned from what your group's doing and what NRMs are doing. If we get our stories right, we've actually got the market, we've got the landholders, the projects. You've got access to funding, we just can't make the two match, and sometimes often it's the thing in the middle that's not allowing it. So I think there's something to be learned from here, is getting our stories right, then to put pressure on government to allow that conduit to happen. That's just my thought anyway.
Yeah, no. Great closing thoughts, Chris.
Thank you. A huge thank you, Nicole. A really, really great presentation and interesting discussion. Thank you for coming along today. So great to see the taxonomy coming together for a whole range of reasons, including what Chris just kind of flagged there as well. Certainly look forward to hearing more about it in the future as it develops. For now, I encourage everybody to head over to the ASFI consultation page and have a read through the paper. It is really well written and clear. Consider making a submission if there's things in there you want to talk about. And to fill out the Menti survey for the In the Tent webinar series that we'll send around very soon. But for today, thank you very much for joining our series, and thank you again to Nicole for your time and wonderful presentation.
Yeah, thank you for the opportunity. It was great to chat to you all.
Lovely. Great. Thanks, everybody.
Thank you.